This is Economic Foundations, Episode 5, Bonds. Not ownership, obligation, not growth first, stability first. Today we define the fixed income market. Bond. A bond is a debt instrument issued by governments, corporations, or institutions to raise capital. When you purchase a bond, you lend money to the issuer. In return, the issuer agrees to pay periodic interest, repay principal at maturity. A bond is a contract. Face value, also called par value, is the amount the issuer agrees to repay at maturity. Most bonds are issued with a face value of $1,000. Market price may differ from face value. Repayment at maturity remains fixed. Coupon rate. The coupon rate is the annual interest rate paid on a bond's face value. If a bond has a 5% coupon and a $1,000 face value, it pays $50 annually. Coupon payments provide predictable income. Income is defined at issuance. Yield represents the effective return an investor receives based on the bond's market price. If bond prices fall, yields rise. If bond prices rise, yields fall. Yield reflects current market conditions. Price and yield move inversely. Yield to maturity, YTMY. Yield to maturity is the total expected return if a bond is held until maturity. It includes coupon payments, price differences between purchase price and face value. YTM assumes reinvestment of coupons. It represents a comprehensive return measure. Maturity. Maturity is the date when the bond's principal is repaid. Short-term bonds mature in less than 3 years. Medium-term bonds mature between 3 and 10 years. Long-term bonds extend beyond 10 years. Longer maturities generally carry higher interest rate risk. Time increases uncertainty. Credit risk. Credit risk refers to the possibility that the bond issuer fails to make interest or principal payments. Government bonds often carry low credit risk. Corporate bonds vary based on financial strength. Credit ratings help assess default probability. Higher risk demands higher yield. Treasury bonds. Treasury bonds are debt securities issued by the national government. In the United States, they are considered among the safest investments. They are backed by the government's taxing authority. Treasury yields influence global financial markets. They serve as a benchmark for risk-free rates. Corporate bonds. Corporate bonds are issued by companies to finance operations or expansion. They typically offer higher yields than government bonds. Higher yield compensates for higher credit risk. Corporate bonds reflect company health. Bond rating. Bond ratings are assessments provided by rating agencies regarding an issuer's creditworthiness. Ratings range from investment grade to speculative grade. Higher ratings indicate lower default risk. Lower ratings indicate greater risk and higher potential yield. Ratings influence borrowing costs. Duration. Duration measures a bond's sensitivity to changes in interest rates. Higher duration means greater price fluctuation when rates change. If interest rates rise, bond prices fall. Duration quantifies interest rate risk. Bond market liquidity. Bond market liquidity refers to how easily bonds can be bought or sold without significantly affecting price. Government bonds are typically highly liquid. Corporate bonds may vary. Low liquidity increases volatility during stress periods. Liquidity determines flexibility. Closing bonds are agreements. They define time, risk, and compensation. Yield measures expectation, duration measures sensitivity, credit measures trust. In fixed income, structure defines return. This has been Lecture -01. Next episode, foreign exchange and macro.